Good morning, everyone. This is Stuart. On this week's update, we'll cover the question of continued U.S. exceptionalism in financial markets and whether Apple and Alphabet are trading places. Are markets signaling something is amiss in the U.S.? Year to date, the U.S. stock market indices are the only material ones with negative returns. Most foreign and developed markets are up more than 5%. While U.S. stocks have recovered from their April lows, we're still lagging our foreign peers. This is an unusual occurrence in recent history. As you can see in this chart of the S&P 500 versus the MSCI World Index X the US, the United States has materially outperformed foreign markets over the last 30 years by nearly 800%. Our forward price to earnings ratio at 22 times is nearly 8 turns higher than the 14.8 times that the rest of the world trades at. To be sure, there are reasons for this. We have the deepest capital markets, the world's largest companies, and a tech sector that's hyper-innovative. Our premium valuation is also predicated on our commitment to capitalism, ease of business, history of dependability, our relative political and geopolitical stability, and the rule of law. Now, we're not a political analysis firm, but insofar as politics may impact any of these bedrocks of U.S. financial asset exceptionalism, we do think it's worth highlighting. The Trump administration, we think, does have a clear economic agenda. It's reshoring key industries and resetting trade relationships, all to benefit the working class, enhance national security, and grow the economy, while also raising tariff revenue. The issue is that the approach to accomplish this has been haphazard at times, including over the last week again, and that slowly can chip away at our global standing. Threatening Apple with a 25% tariff for phones not made in the US, the legality of which is questionable, or threatening to expel foreign students from Harvard, the very type of students who we in theory should want to attract to contribute to our economy longer term, risks having a chilling effect on business, foreign investment, and human capital. Again, we think much of this is likely bluster to achieve broader aims, but it's worth noting that political volatility, whether in the executive branch for arguably the last decade, or congressional dysfunction, is not constructive for U.S. asset valuations, and that's not to mention our fiscal profligacy and rising interest rates. We don't think political analysis should detract from the fundamental work of selecting great companies to invest in. But it's the kind of thing that in the background could slowly and perhaps imperceptibly weigh on stocks over years and result in the valuation gap between the US and foreign markets narrowing. Speaking of valuation gaps narrowing, we wanted to end with a discussion of Apple versus Alphabet, two companies that we've talked about at length in recent weeks. If you looked at the revenue growth rates for the two, you might think that Alphabet is the firm with the 27 times forward multiple and Apple trades at 17. Now, if you recall, for much of the 2010s, Alphabet, or Google as it was named then, traded at a premium valuation to Apple and was experiencing higher growth rates, while Apple struggled with the perception that it was just a cyclical hardware firm. The services narrative really flipped the script for Apple. But the question is, will artificial intelligence now result in the two trading places yet again? Much has been written about Apple's struggles in that field recently, and we've commented on it as well, so no need to rehash. We've also discussed how Alphabet is overly punished for the pessimism around Google search and doesn't get credit for its technical prowess or other dominant businesses like Cloud, YouTube, and Waymo. Now, here's a thought experiment. In a world where AI makes content creation easier, especially trashy content, isn't the ability to intelligently parse through massively more content and serve ads against quality search results worth a lot more? We think the answer is probably yes. We still think Apple can work its way out of its current impasse, though. But the valuation premium over Alphabet is getting harder to justify to this degree. We also think that this likely gets resolved by Alphabet trading higher over the coming years. If you have any questions about anything we discussed in this video or your portfolio or markets generally, please feel free to reach out. Thank you very much and have a great start to your week.